We just finished going through SpaceX fiscal 2026 second quarter earnings call materials, and now we want to share our takeaways with everyone. And look, I know what the market wants to talk about with this name, rockets and Mars and the founder's latest post. Fine. Let's talk about something better. Let's talk about the fact that profit here grew twice as fast as revenue. That's the part nobody puts in a headline, and it's the part that actually decides whether this company is worth what it's worth. I came off this call genuinely wired, and also with one number stuck in my throat that I'll get to. Alright, the top line dashboard, and I'm gonna give it to you straight because it's a big one. The company reported 7.8 billion in revenue, up 92% year over year, driven by Starlink and connectivity. Adjusted EBITDA came in at 3.5 billion, up 91%, which means profit grew more than twice as fast as the top line. That's the tell. When earnings outrun revenue by that much, you're watching operating leverage bite, not just demand. Then the timeline moved. The company's internal $1 trillion revenue forecast has been pulled forward from 2031 to 2030, with what they call a non-zero probability for 2029. Now the number that stuck in my throat, second quarter capital spending hit 18.4 billion. That is 2.4 times the entire quarter's revenue. And the deck's own synthesis asks the right question. Is this acceleration organic demand, or is it being brute forced by capital? Hold that question, because the rest of this deck is really an attempt to answer it. Here's the structure, and once you see it, you cannot unsee it. Pillar 1 is Starlink at 4.3 billion in revenue, described as the absolute profit backbone, an overhead bandwidth subscription network for homes, aviation, and government. Pillar 2 is AI compute at 2.6 billion, the aggressive latecomer, massive data centers training Grok and renting compute to Google and Anthropic. Pillar 3 is space itself, and the company labels it the foundational bottleneck rather than a revenue line, with the smallest revenue of the three by an enormous margin. But look at what that bottleneck controls. The company states it holds 80 to 90% of global orbital payload mass, roughly 500 tons. The entire rest of the world combined is about 300 tons. That's not a lead, that's a different category of thing. The current catalyst they name are V3 satellites at 10 times capacity, 1.4 gigawatts of compute scaling rapidly, and Starship targeting 4 times the payload at a tenth of the cost. Our take is that this is one genuine monopoly, quietly paying for two ordinary businesses to become extraordinary, and that structure is rarer than any single number here. This page is about permission, and I mean that literally, the permission to do things other companies cannot. The company reported net loss nearly halved to 541 M, a 467 M improvement year over year, which the deck calls directionally definitive. EBITDA up 91% against revenue up 92% is described as classic economies of scale biting, where marginal revenue generates exponentially higher marginal profit, and then the balance sheet, 100 billion in cash and marketable securities. The math behind it is 85.7 billion of net IPO proceeds, plus 25 billion in priority notes at a 5.855% rate with 11.7-year duration, minus 20 billion of term loan repayment. Borrowing long and under 6% while your EBITDA nearly triples is, I'd argue, the single smartest financial move in this entire deck. The backlog sits at 475 billion, which is a number I had to read twice. The deck's diagnostic is fair. The first two facts prove the core business works, and the cash pile proves they can now bypass the growth constraints that bind everybody else. Now let's trace where the cash actually flows, because this page is the honest plumbing diagram. Starlink is the engine, 4.3 billion in revenue, up 66%, throwing off 1.7 billion in operating profit, up 79%. That profit flows into space research and development, which has 0.96 billion of revenue and negative 2.5 M of adjusted EBITDA. The company frames those space losses as an intentional trade, giving up current profit to buy a future structural cost advantage. Then the second flow. AI compute pulled 2.6 billion revenue, up 218%, with positive 1.1 billion of adjusted EBITDA but an operating loss of 1.3 billion. Read that gap carefully. EBITDA is positive while massive depreciation and R&D remain uncovered, and the deck says so plainly. And critically, that AI growth is not funded by Starlink. It's brute forced by external cash from the war chest to capture a time window. Our take is that Starlink earns its way and AI is buying its way, and those two bets carry completely different risk profiles even inside the same company. Here's a page I genuinely admire because it answers the objection before anyone raises it. The company added 1.7 million net consumer subscribers in the quarter, which they state is a quarterly record. And here's the part that matters. Average revenue per user held steady at exactly 66 a month. Think about what that means. You can always buy subscriber growth by cutting price, and the moment you do, the growth is fake. So holding price while adding a record number of users is about the cleanest evidence of organic demand you will find in any deck. Underneath it, enterprise and government revenue grew 108% year-over-year, vastly outpacing the division's 66% average. The company cites a 60B plus US government contract secured %% churn on enterprise clients and aviation penetration still under 10%. Zero churn with under 10% aviation penetration is the combination I'd want on my side. And our read is Starlink is quietly turning from a consumer subscription into infrastructure rent. Now here's the constraint, and it's a physical one, which is refreshing after a decade of software excuses. The company reports roughly 10,200 satellites in orbit with 9,600 broadband active, delivering about 800 terabits per second of total downlink. The V3 math is where it gets loud. 10 times capacity per satellite multiplied by 10 times launch volume equals a 100 times bandwidth leap. But you need roughly 1,000 V3 satellites in orbit to fundamentally alter the user experience, and the company projects that for the second quarter of 2027. So Starlink's revenue ceiling is not set by demand, it's locked by the space division's physical ability to deliver hardware to orbit. The deck says it without flinching. 2026 is a holding pattern and the step function happens in 2027. To be fair to the bulls, a bottleneck you own is far better than a bottleneck a supplier owns, and they own this one entirely. But our take is that anyone modeling a 2026 inflection here is modeling the wrong year, and I'm about 75% confident on that timing call. Alright, this is the page where I'd slow down if I owned this stock, because the logic is elegant and the exposure is real. The company spent 15.8 B on AI capital expenditure in this quarter alone, against 1.6 B generated from the new Colossus 1 and 2 cloud contracts. They also point to 6.7 B in newly signed cloud contracts in the third quarter, scaling from October 2026. Capacity goes from 1.4 gigawatts today to 2 gigawatts by December 2026 and roughly 10 gigawatts by December 2027. Management justifies that pace by citing memory supply growing 20% against AI demand growing 200%. And honestly, if those two numbers are right, the aggression is rational. Their claim is a payback period under 1 year, which is the kind of number that makes capital spending feel like cost of goods rather than investment. Here's the vulnerability, stated right on the page, that payback rests entirely on peak GPU rental rates holding. If supply catches up and rent prices slide, the deck warns the capital block crashes down and instantly destroys the economics, and I put that risk at real but not imminent. This page is about the difference between telemetry and a teardown, and it's a distinction worth internalizing. On the verified side, the company states Flight 13 successfully validated orbital insertion and return targeting. Overall first half 2026 launch activity was 78 flights delivering 1041 tons to orbit, which is a genuinely staggering operational cadence. Now the unverified side, the founder claims the heat shield problem is solved with no barriers to rapid reusability. But the deck notes the Flight 13 hull is still floating at sea, so that claim rests on telemetry rather than physical teardown and validation. That's an important gap. Telemetry tells you the vehicle survived. A teardown tells you whether it can fly again next week without a rebuild. The next hurdle is Flight 14 in late August 2026, attempting the first tower, catch of the second stage, and deploying the first Starlink V3 payload into operational orbit. The strategic note is exactly right. Its valuation only shifts from research risk to manufacturing scale risk after the physical teardown is verified, and until then you're paying for a promise. 3 claims, 3 translations, and this page does the work most investors skip. Claim 1, AI compute payback is under a year and capital spending feels like cost of goods. The translation is that unit economics are currently flawless but depend 100% on peak rental rates, so gigawatt expansion metrics matter less than the stability of price per gigawatt contracts. Claim 2, V3 is a step function and you can't extrapolate from historical V2 data. The translation is that the hardware specs are proven while physical deployment is bottleneck, making the 100 times bandwidth leap fundamentally a 2027 story tied to Starship cadence. Claim 3, the major technical barriers to reusability are cleared. The translation is that progress is extraordinary, but the milestones are currently self-assessed via telemetry, so true manufacturing scale risk cannot be modeled yet. Our read is that every one of these claims is probably true and none of them is yet verifiable, and that combination is exactly where expensive mistakes lie. Here's the number that stuck in my throat during the opening, and now I'll pay it off. In the illuminated zone, the company gives you real detail, roughly 10% internal use expected for Grok, 30,000 to 50 per watt monetization, and an exclusive pivot to NVIDIA's Vera Rubin. I'll credit management here. The founder actively downplayed the 20 gigawatt goal to 15, and revising your own target downward buys real credibility. Now the shadow zone. The company confirmed intent to use 65 MHz of EchoStar spectrum and launch 100 times more mobile satellites by 2027. That is a plan to compete with terrestrial mobile networks, which is a fundamentally different capital problem. When analysts pressed on the more than 100 billion of capital spending required to rival US telcos build versus reselling, the company's president definitively refused to answer twice. So a capital commitment potentially larger than the entire current war chest is sitting completely outside every public model. Our take is this is the single most under-discussed item in the deck, and one disclosed number here would move the stock more than any launch will. This page reframes the whole company, and I think it's the most intellectually interesting argument in the deck. The claim is that SpaceX is not diversifying into data centers. It's running a manufacturing capability arbitrage. Orbital engineering forces you to solve extreme heat, severe mass limits, and vacuum, all under constraints that would break a normal engineering team. Terrestrial data centers, by comparison, get standard racks, commercial cooling, and plentiful mass, which the company frames as merely difficult rather than impossible. Point a team built for impossible physics at a difficult problem, and you capture the spread in execution capability. And that's the core insight. The evidence they offer is infrastructure first, building power and cooling massively ahead of GPU delivery, which is a classic heavy manufacturing mindset. They also cite bi-directional innovation, with the Starman satellite described as a hardened version of a standard high-end GPU rack. And the threat, stated honestly, is that this arbitrage only exists while the bottleneck is engineering capability, because if it shifts to utility power permits or GPU allocation, the unique edge evaporates. Now the roadmap, and I want to point out something about it before we walk through it. Late 2026 has Flight 14 in late August for the first tower catch and first V3 orbit. Compute capacity above 2 gigawatts by December, a 100 B annual run rate achieved by December, and the Grok 5 launch plus the Cursor acquisition closing in the fourth quarter. For 2027, roughly 1,000 V3 satellites active by mid-year, which the company calls the service inflection point. Also mid-2027, Starship flying once per day, then late-year compute near 10 gigawatts, mobile V2 satellites beginning launches, and Artemis docking. 2028 brings the lunar surface landing, and 2030 carries the $1 trillion total revenue milestone. Some of that is science fiction with dates attached, and I'm not going to pretend otherwise. But here's the analyst note I agree with: management's willingness to publicly self-assign failure rates, like actively revising the gigawatt targets down, meaningfully raises the trust you can place in this specific timeline. A team that lowers its own numbers unprompted is telling you something true about the rest of the sheet. The company closes with 6 telemetry metrics, and these are genuinely the right 6, so write them down. 1 AI contract pricing, tracking price per gigawatt on new signings, because gigawatt scale means nothing if that sub-1 year payback deteriorates on oversupply. 2. Enterprise mix, tracking Starlink's 66 baseline and the enterprise share growing 108%, watching for global localization strategies that dilute blended rates. 3. Starship cadence, the gap between 78 flights in the first half of 2026 and the stated goal of 1 flight per day by mid-2027, which the deck calls the widest gulf in the projections. 4. Space EBITDA inflection, currently negative 2 where a definitive move to positive signals the Starship capital investment phase is ending. 5. Cash burn crossover to 18.4 billion quarterly capital spending against the 100 billion war chest, tracking when operating cash flow fully funds all expansion. 6. The mobile capital spending reveal, meaning the quarter that unmodeled Starlink mobile ground network spending finally hits the balance sheet. Alright, last thing, radar always leaves you a light. I'm calling this one yellow, and I want to be honest about how close I came to green. The business is working, and I don't say that lightly. Profit growing twice as fast as revenue with pricing held flat is about as clean a signal as this job offers. What holds me at yellow is that 2 of the 3 pillars are currently funded rather than earned, and there's a capital commitment north of 100 billion that management twice declined to size. Here's what flips me to green: Flight 14 catching that second stage plus any hard number on Starlink mobile ground spending. Here's what turns it red: price per gigawatt slipping on new AI signings while capital spending keeps running at 2.4 times revenue. If they catch that booster and open the books on mobile, I'll come back on this channel and tell you yellow was too cautious, and I'm telling you that up front. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like, and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.